Hello, hello, hello. It's Tuesday night. It is 8:30, not on the dot, but it is 8:30. And we are so excited. How is everybody doing? Have we recovered from Super Bowl? Have we recovered from Valentine's Day? Oh, my hair is a hot mess tonight. So let's talk about Super Bowl. Did you guys watch the Super Bowl? I watched it and our whole family was cheering for the Rams. So we were very excited. We let Liam stay up late and watch it, and he told us that we were crazy awesome parents. So that was really cool. It was great to have that time with him and experience it because it's not often that we're all cheering for the same team, because usually he's at that age where if I say it's blue, he's going to say it's green. So that's what's going on there. So I hope everyone is doing well. I hope that you are staying warm. It got warm here today in Lafayette. I don't know if it was warm where everyone is viewing in from, but it was definitely warm. It's supposed to be over 50 tomorrow, so I'm looking forward to that. So welcome to tonight, ReLive. We are going to talk about mortgage matters with Megan, and we have with us Megan Von Dilligan.
Yeah,
and she is a loan officer and has been a loan officer since 2001, shortly after she graduated from Purdue University. So boiler up, because my first guest was from Purdue also. She met her husband, Jason, at Purdue, and they have two kids, Kendall and Hayden. And as a family, they spend a lot of time at dance competitions with both kids competing and basketball games. And when it's warm out, their favorite thing to do is spend time by their backyard pool, hanging out with their friends. Sounds like a perfect day to me. She loves to educate people about the financial part of home buying. And she likes to catch it right in the very beginning when it's just a small little dream in your mind, and to take you all the way through the process to the very end when you've got the keys in your hand. And I can attest to this. Megan did an excellent job. The experience of her clients is the most important part, which customer service is huge. So Megan is your girl if you're looking for a great experience. She often spends time with first-time home buyers, going through her Mortgage 101 class to help them feel really comfortable with the process and to know what to expect. Megan takes pride in serving her clients and catering their experience to fit their specific need, while educating them along the way, because education is a big part of the process. She is an expert in her industry, ladies and gentlemen, and realizes that this is one of the biggest purchases you're going to make in your life, and she wants to make sure you make the right purchase and it's as smooth as possible. Megan works for a company called the Mortgage Exchange, and I would like to have you welcome Megan. So welcome, Megan, to ReLive. Thank you for coming tonight.
Thank you so much for having me. I'm just so excited to see you in video and on real life.
I know. I'm so excited also. I have known Megan for goodness. It's been over, I think, about 10 years.
Yeah, it's been a minute.
I think I joined Premier right around the time Liam was born. So yeah. So Megan has been very helpful in buying this home and refinancing this home and helping us save money. So it's been great. So Megan, I said that you work for the Mortgage Exchange, which is not a bank. So why don't we talk a little bit about why somebody would want to work with you versus working with their bank that they go to every day?
That's an excellent question. I get that a lot. Even some of my close friends are like, what do you do exactly? What is this you do? I bank at Chase or I bank at PNC, and why don't I just walk into the lobby and talk to a person there? And I'm like, well, here's the deal. There's different avenues to borrow the same money. You end up in the same place at the end, generally speaking. A lot of it has to do with the experience along the way and what the terms are that you're going to get. And sometimes a lot of it has to do with the variety that you get with the different kind of lenders that you work with. So that you can go to a bank, which is a depository with checking and savings accounts. They have a kind of a different set of rules and a different governing body, so to speak, but they may have more specific programs in terms of like construction or lot loans and things like that. They're a little more specific in what they lend. I think I've never actually worked directly for a bank, I should say that, but in my experience, it's a little more honed in that regard. Sometimes they're not able to do some of the more challenged credit situations or anything outside the box. I don't think that's their forte. additionally, there's like a lender. So a RUOF or a Fairway is a lender that's a direct lender. The loan officers that work there, you call them. Again, it's been a long time since I worked directly for a lender, but from my experience of working directly for a lender, I would give a program choice based on what that lender offered and what, here's what we can do for you.
Okay.
From my perspective as a mortgage broker, which technically I'm a banker, so a mortgage banker, we call ourselves brokers, but as a broker, I work with about 15 lenders. So my licensing allows me to go to this investor over here, which is a mortgage company, this one here, this one here. So when I take an application, I can literally say, okay, I've got this application with this different scenario. Where's this going to fit the best? And then I can help them figure out where to go for that. So that's mainly the difference, is my licensing allows me to pick and choose based on that scenario.
Finding the best fit for the client.
Finding the best fit. Yep. So a little bit different.
So you're like a little puzzle maker person.
Yes, I'm a matchmaker of sorts.
You're a matchmaker. Awesome.
Match the investor to the client and what the situation is. And that one of the things that does is it really helps me to work outside the box and really cater it specifically to that person's needs, which I love. So
yes, I think you and I have had conversations before where you've had to kind of think creatively because this particular situation didn't fit the standard XYZ. And so you've had to think creatively to get it to fit.
And most investors may not do that, but this one over here will, and I have a licensing to lend their money. So that's how that works. Oh.
Cool. Yeah. So you have your hands in a lot of different people's pocketbooks. Different people's pots of money.
I like the way that you say that. Yes, I do.
Awesome. Well, let's talk about, this might be something that people are really interested about. For the past, I don't know, 2.5, 3 years, maybe 2 years, you probably know better than I do. The market has been crazy. House prices have skyrocketed. Houses are going for a lot more money. I'm like, really? That's how much that house is?
Yes.
So people that are still wanting to buy a house, should they wait? Is the market going to go back down? Kind of like, what are your thoughts there?
Okay, these are my thoughts. I wish if only I had that crystal ball, this would be so much easier to know how to answer that question. But it is definitely the hot question. So my opinion of that is that we're not in a bubble. I get the bubble is the kind of buzzword that we get a lot. And I don't believe we're in a bubble. I've done this since before 2008. I started in 2001, and this isn't the same kind of lending. It's not the same situation. I mean, your jaw might drop when you hear me say this, but there were loans that we could do for people in 2006 that were over the value of their home. So if we got an appraisal for 200,000, we could lend for like 115% of that amount. So we were lending over and above, and that's what people wanted. We didn't know any better, and people would call and want those loans. So we would do them for them, and they were available and we could do them. So it was a crazy time in lending, and values were teetering, and there was a lot of other layers to that with appraisals and things like that going on. And it was a bubble. This isn't the same problem. We're not in the same situation. So therefore, I don't think we're going to have the same result. I don't think we're in a bubble that's going to pop where values are going to go down. I think people can somewhat create that for themselves when they would go way, way over and they're willing to pay way over. They might end up being a little bit upside down on the value based on that specific situation, and different markets are going to be a little bit different in that regard. But by and large, we're not in a bubble that's going to pop like it was. Therefore, generally speaking, the average person isn't going to start losing their value. So I just don't think that's how it's going to go. Now, to answer the question, is it going to slow down? I think eventually it's going to even out a little bit. I think everybody kind of knows that we've been very out of balance. There's a lot of buyers and there's not a lot of houses for sale, which is really the problem, is more of an inventory issue. I think interest rates are going up. I think we're going to talk about that here soon too. And that's going to shift the market a little bit because of that. But by and large, we've got a long way to go before we find the equilibrium of that. Additionally, there's more humans coming into the market, like the ages, like the people having kids long enough ago that those people are now coming into the market as home buyers, and there's still not enough houses for sale. So it's not like our population is helping that either. Like there's a lot of things going on that are going to keep this supply and demand out of balance for a while, I think.
I'm surprised that there aren't enough houses available, because everywhere I look, there are new neighborhoods going up, new houses, new houses, new houses. And I'm like, who is living in these houses?
A lot of people. I know. It's
Where are all of
crazy.
these people coming
Where are the
from?
humans coming from? I know it's a crazy thing, but then on the builder side of things, which I work with builders. I do that quite a bit, but that's not what I do the most of. So I'm not a builder lender or builder's lender, but I do loan. I have closings all the time. I have one in a couple weeks with a builder. So I do them a lot. And it seems like, they're running into the same things we all see when we go out to buy supplies and things like that. Like it's getting more expensive and there's supply issues and all of that. So
Sure.
yeah.
So we didn't talk about this previously, but I'm going to throw this out there, and then we can come back to it if you want to. What I am seeing, I feel like there's not a lot of like first time young homes available for that market. Like my first home was under $100,000. Like I feel like that just doesn't exist anymore. It's like you'll be lucky to find something for like 150 in our area that's, like your 3-bedroom, 1-bath house. What are you seeing as far as the money you're lending?
I agree with that. Yeah, I think that's fair to say. There's not a lot of small ones out there that are suitable for people just coming out to buy their first house. But I also think that it's all relative. So the starting salaries of jobs have also gone up. So, that all of those things kind of creep up together. And right now they're sort of tracking at the same pace-ish from the research that I've done. So I think there's not a lot that you see that are these, and when they're there, they get bought up by cash buyers. And so they're just not there for very long. Yeah. So you're not wrong in that observation. That's for sure.
So then I wonder if in 3 to 5 to 8 years, if we're going to see a problem with like first time home buyers who were required to go maybe $10,000, $20,000, $50,000 more than what they really anticipated, if they're going to have a problem keeping their homes.
Yeah, that could be. The good news is now we're more strict than we used to be on the requirements for that.
Yeah.
So they've tightened up what people can get into for that reason, which I think helps a little bit too.
Okay.
I mean, it seems like in 2006, I could lend some money with a fist bump. And these days, that is not the case. There's just a lot more to the process, which is why I care so much about educating people. So that they, my favorite clients that I can start with are the ones that are just jumping in and they have no idea, but they're not ready. They're telling me we're not going to be ready for like 6 months. I'm like, perfect.
Yeah.
Not that I don't love the people that call me and say, I'm standing in the kitchen of a house I want to write an offer on in 2 hours. Can we do it right now? And I'm like, no problem.
That would be me.
We'll make it happen. It's totally fine. But when they call, like you said, these first time home buyers that can kind of prep themselves and prepare and they can save and maybe use their tax return for part of their down payment funds and really get themselves in position to do it. I'm like on my own personal mission to like help as many of those people be ready as possible because I don't want them to go in and foreclose in 2 years either. That's not good. That's not good for any of us. Nobody wins when that happens.
Right. Exactly. Okay. So that brings up a good point for those that are watching. And if you're not watching live, make sure you hashtag replay so we know you watched and ask your questions because we'll be checking this as the week goes by. I mean, I get notification. What is a good timeline for those that are thinking, is it 6 months? Is it a year, especially in today's market?
So I think that's an excellent question. So you need to have a little bit of down payment funds to be competitive. I mean, I don't feel like right now is a time where you can come into this and be like, I need a down payment assistance program and I need seller paid closing costs and I need these things. You want to have your ducks in a row and have a clean offer and have at least 3 to 5% down on a transaction. So on a conventional loan, the very minimum is 3 if you can qualify for 3. And there's some parameters to that. And then 5% on a conventional loan. On an FHA loan, which is a little broader in what you can get qualified for, but you only need 3.5% down. And I can answer any questions about the difference in those two paths to borrowing money. But yeah, that's really the minimum it needs to be.
Okay.
Credit score wise, it's pretty broad. You can really get down to 580, but it may not be pretty, but it can happen.
Okay. So that's a couple of questions that I had. And I think it's really great because people are watching and you're saying, oh, I only need 3% down. I thought I always had to have 20% down to
Yeah.
buy a house. So let's talk about that a little bit. What does that look like? Do you have to have 20% down? You're saying no,
No,
but
you
is
do
that just
not.
because there's different options?
Most people don't have 20% down, especially first time home buyers. I
Mm-hmm.
mean, hardly anybody has 20% down. It just barely exists anymore. So,
Mm-hmm.
unless they're selling a home and then getting into their next home, which
Mm-hmm.
comes with a whole nother layer of circumstances these days when you're trying to write an offer on a new house, but you have to have your old one sold in order to write the offer. That's a whole nother thing that we have to work through that's in this crazy market, but that may
Yeah.
not be that way forever. But no, you absolutely do not need 20% down. I would say, I'd have to go back and look statistically, but I would guess that more than maybe half of the loans that I do put down 5 or so percent. And
Mm-hmm.
then the rest of them are like 10 to 20% down. So really most people don't have 20% down, and that's okay. That's not a problem. You know,
Okay.
not a bum deal. It's nothing like that.
All right, guys. So you don't have to have 20% down, and I'm hearing that a lower credit score, you can work with people with a lower credit score. Let's talk about that a little bit. And for
Yeah.
somebody that doesn't necessarily have the best, what are some things they can do to increase their credit score?
Yeah, you really don't have to have perfect credit to do it. There are certain hard stops in that if you have issues on your credit that you just have to deal with before you can be ready to buy a house. I know I talked to people. I had a conversation with someone tonight that I was like, we'll check your credit and we'll see where it's at. And I'll let you know exactly if we're in a good place to do it, we'll move forward with the pre-approval. If we're not, I'll guide you on what it takes to get yourself in position to do it. And I tell people all the time, I'm not a credit counselor, but I pull credit every day. I look at credit reports all day, every day. And I
Yeah.
know what it takes to buy a house. So I
Mm-hmm.
can, there are tips and tricks to that a little bit. So, I would say one of the biggest misconceptions, I guess, is a good way to answer that question is that people think that having lots of credit and using all of it is
Mm-hmm.
really going to help their credit score. Because, oh, look, I'm using my credit. So that's what I'm
Mm-hmm.
supposed to be doing, right?
Mm-hmm.
Not necessarily. You really don't want to max out anything. You just
Mm-hmm.
don't. That is a big deal. So if you've got a $10,000 limit on a credit card and you keep that balance at 8,000, that is going to kill your credit score more than
Mm-hmm.
I don't know that the computer models have changed that over the years. I feel like they have. I feel like that didn't used to be quite as bad as it is now.
Mm-hmm.
But I see people that otherwise would have really great credit, but their credit cards are maxed or close to maxed or in that range over 75%, and their scores are in the mid 600s. And they're like, what am I doing wrong? I'm like,
Right.
you got to pay your balance down. You
Right.
really, ideally, the people I see with 800 credit scores, their balances never go above like 10% to get
Mm-hmm.
reported or when they get reported, the balance gets reported to the credit report. So that's a
Right.
huge deal, is to pay that down. Obviously, no lates is a big deal. Things like that. Like I said, I'm not a credit counselor, so it's hard to advise people, but I always tell them,
Mm-hmm.
do your own research. But if you don't have any credit, if you're just brand new and you just graduated from Purdue
Mm-hmm.
and you and you're wanting to get going on something, then you can open what's called a secured credit card, and you can Google it. I'm
Okay.
not trying to endorse any of them, but it's a thing that can happen where instead of you borrowing their money and then you're using their money to make a purchase or fill your tank with gas, you can then use your own. So you basically hand them $1,000 to hold on to. They
Oh,
give you a credit card, you go use it for gas and groceries and make the payments to pay it off every month. And then you're not using someone else's money, you're using your own, but you're using it in a way to show that you can pay things on time. So
interesting concept.
it is an interesting concept, but a lot of times when it comes to credit, again, this is my own version of how I describe it, but there's a good pile of credit and a bad pile of credit. You really need the good pile to be really good, and you need the bad pile to be gone or going away, or you're working on making it smaller. It's not really too hard to figure out what those things are in each one of those piles. So
Right.
on-time payments, low balances on credit cards, those go into that good pile.
Right. Right. And if you guys were watching last month, we talked about getting out of debt. And if you have those credit cards, you've got to pay more than the minimum to get rid of it. So if
Yep.
you
And you
didn't
don't.
catch that, you can go back and watch it.
Uh-huh.
I remember somebody had told us, like, we had a couple different credit cards, but we didn't use them. And they're like, just keep them open though, because it
Yes.
keeps your available credit versus what you're using ratio, I guess, down.
Yes.
So it doesn't look like you're using everything you
It's
have.
called your utilization percentage, basically.
Right.
Yeah. The amount
Okay.
you're using of your overall credit.
Interesting.
I could
And
do a
then,
whole thing on just credit because it's quite a mystical creature sometimes.
right. And then the other thing I've heard was that if you don't have any credit, to at least get a credit card and use it for like your monthly, like go to the grocery store, use it, and then pay it off. Don't carry a balance, just pay it off so you can build that pile of good credit.
Or what can happen is at the end of the statement date, that's really the key date that reports. So like my husband and I have a card that we get points on for an airline, and we the 19th is the magical day every single month, and that's the whatever my balance is on that day is going to report to the credit report, and that's what's going to dictate what happens to the score. And if that number is over 10% of the limit, then it's going to pull my score down. That's just how it works.
Wow, I've never heard about the statement date.
And the statement date, when you pay it in full, you don't have to pay, like our balance on that card is never zero. Never. We literally do everything on that card and then pay the card off, per the statement balance. So then that never rolls over to collect interest. So we never pay interest on it ever, but we also never have a zero balance. So if anybody has any more questions about that, feel free to reach out about it. It's kind of it's a thing that people don't realize. That statement date is the magical date. That's the date you have to pay off your balance that would roll over if you didn't pay it down to zero.
Right. Yeah. We also, we do not pay interest. We always say the credit card companies hate us because we use them for the rewards, but we never pay them.
And we picked one and we focused on that one because, you can't, we chose not to spread it out, but we have others that are open that just have a zero balance on them too. And if you have a zero balance on a card that has an annual fee on it, anything that's hanging out open that you're not planning to use, but you're not going to close it out, set it up on auto pay. Just trust me, because you'll get a $29 annual fee or whatever, and you're not paying attention because you never use that card anymore because you paid it off. Good for you. And then that $29 pops up and you don't realize it because, again, you're not paying attention. And then you get a 30-day late because you didn't pay off your $29, and then you get dinged on your credit. I've seen it happen lots of times. And people are like, I wasn't using the card. I haven't used it in months. I'm like, right. And your annual fee came around, you got charged. So put it on auto pay and they'll take that right out of your account. You won't even feel it.
Yeah. Or here's an idea. There's lots of cards that don't have an annual fee.
Don't have an annual fee. Yeah. There's also that. Yes. But don't close all of the ones that you have to open ones that have an annual.
Right.
Be smart about that whole strategy.
So we talked about you don't need a 700 score. You can do, you've got some things that are a little less, and you've given some advice on how to increase the score. And I'd love to hear from anybody that's watching. I know we've had some people pop in and out, share your experiences or ask any questions. We would love to hear those. Let's talk about refinancing, because I think a lot of people don't realize that's something that they could do to help save them some money. I know we've done it a couple of different times. So what exactly is refinancing? And I guess when is it a good time to do it?
Yeah, that's a great question. And it's a tricky question right now because the market is moving and the rates are not going down anymore. We're past COVID-ish, relative, I suppose, but we're in the rate world. We're moving beyond COVID. The market is changing and interest rates are headed up. They just are. I don't know how fast, and we don't know how high, and we don't know all those things. I don't think it's going to be a steep jump in interest rates, but it's, they move daily. So with that in mind, refinancing, everybody was refinancing when they were, had a 4% interest rate, and then they wanted to drop down to a 2 whatever interest rate, which is great. I've had a couple scenarios that have come up to answer that question. One of them, I've had somebody that was like, we now have, our house has gone up $150,000 in value in the last 2 years, and we've got all this equity. And they're staring at it like they're looking through a window at their little equity pile, but they can't touch it because there's no way to get to your equity. It's not a liquid asset that you can get to. So the only way you can get the equity in your home, and the equity is the difference between what you owe on your house and what the house is worth. So for example, if you owe $250,000 and your house is worth $400,000 now, because of all the appreciation in the last 2 years, then you have $150,000 in equity. And there's only a couple ways you can touch that equity. One of them is to sell your house and to take the $150,000 and stick it in your pocket. But then where are you going to live?
Exactly.
Well, not we
You're
have
going to go pay $450,000 for
to
another.
buy the next one. Yeah, therein lies the problem. Then another way to get to it is to do a home equity line of credit, which is like a second mortgage after your first mortgage that you can get, that is a second lien, that you can access some of your equity that way. And there's pros and cons to getting that. And then a third way to get to it is by doing what's called a cash out refinance. Well, in essence, a refinance, whether you do cash out of it or not, is just to take your existing loan, redo it with so you pay that loan off and start over with a brand new mortgage. It doesn't necessarily have to be stretched back out to 30 years. It doesn't necessarily have to be, any specific kind of terms. There's 100 different ways to do it, but it does replace the mortgage that you already have with a new one, and generally with better terms. One thing I've seen a lot of lately is a cash out refinance, meaning that you replace your old mortgage, and not only do you pay that one off, but you get a bigger one, and that difference they hand back to you in the form of money. So people are calling and saying, we got $150,000 in equity and we have got to do something, like the deck is falling off the back of the house. Like, how can we do that? Or we really want a pool, or we really, whatever, any number of things that we got to redo this kitchen for many reasons or whatever. So then they're like, how can we use this equity? And usually the couple of, then they're like, we don't want to move. Okay. Yeah. So there's two choices. Basically, you get a home equity line of credit, or you refinance and get cash out of your transaction that way. I've had 2 loans in the last since Friday that they were still in the high 4s. One of them was in the 5s, and they just couldn't refi before now. And they're thrilled to be getting down into the low 4s right now, or 399 or whatever they're getting into. And they're not getting any cash out. They're just redoing what they have. And now they're able to do it. So they're still lowering it. And each of them, I had 2 almost identical. Each of them saved about $250 a month on their mortgage payment. They couldn't be happier. And then I've got other people, strangely, and this one kind of boggles my mind a little bit, but everybody's circumstances are different. And that's why it's worth asking. I've had a completely different situation where they bought their house, 18 or 19. They refinanced when the rates were really low, down to like 275. But now they've got this boatload of equity. And I'm like, you either get a HELOC or you redo it. And I have somebody that's getting ready to close, and they're doing it at like 3.5%. And it's debatable whether or not that's mathematically the right way to do it. But it gets them money they need to pay off, other life circumstances that have come up, and they really need to be able to access that. And they're like, we don't want a second loan, or, whatever. Everybody's different. So life needs can be met through that. Financially, it's not right for everyone to refinance. It's not right for everyone to move their rate up or down. It's not right for everyone to get cash out, but there are tons of benefits to at least checking it out.
So in our situation, we were less than a year out from closing on our house, and the rates dropped, and we were like, does it make sense to really refinance or not? So I guess because there are closing costs involved, is there like a rule of thumb that it's like, well, if you're going to be there so long, or
so mathematically, the earlier in your loan you refinance, the better from a mathematical standpoint. So don't feel like, generally you would need to wait it out for about 6 months, and that's a whole nother story of why that is. But after that 6 months that you've been in a loan, the earlier you do it, because it's a fully amortized loan, meaning you're paying, it's top heavy on the interest at the beginning. So if you refinance it at the beginning to lower the interest, you're better mathematically to do it sooner, I would say. Yeah. So you don't really need to wait. If it's really when you have a need. I've always looked at it as like, people have a need to do something, and they have this asset, and I'm just there to help them meet that need with how we utilize the loan on that asset is really all that it is. So that's what it comes down to. It just depends on the circumstances.
Right. So what I'm hearing, guys, if you have a need and you think refi might answer it, contact Megan Von Dilligan. Yes. She'll help you out.
I will. And I love just talking out the numbers and being like, and I've told people before, don't touch it. It's not, you shouldn't do anything. You know what I mean? Like, you need to figure this out a different way, because refinancing is not what you want to do.
Your answer.
I've had that conversation with people in the last couple of weeks, because they were like, we want to refi. I'm like, no, you can't touch that rate that you have on that first mortgage. You need to stay put. And then maybe in a year, if you still have that need, we can reevaluate the situation. But
right. And you guys, she's wonderful. When we were refinancing, I'm like, what's the rate now? Every 2 days, what's the rate now? And she'll tell me, and then I'm like, okay, maybe we'll do it. And then I'd be like, Can you tell me what it would be if we did a 15-year mortgage? So she can help you, like, to help guide your decision, I guess, to see like
Yeah.
where you stand.
Yeah.
Let's talk about, you mentioned earlier, like locking in your interest rate. And let's talk
Mhm.
about interest rates, because that's the biggest, I think, anxiety inducing thing is like, do I lock it in today? But tomorrow it might be better. Like, how
Yes.
do you know, like, when is the right time? Is there a magical time to lock in your rate?
Oh, yeah, that's a tricky, it's tricky to do that. So I have a chart that I watch all day, every day. Essentially it's based on what's called mortgage-backed securities, and mortgage bonds is what we
Mhm,
look at to see what the charts are doing. People think like I have to giggle to myself when the news reports that the Fed is raising or lowering the rate. Everyone assumes that means the 30-year mortgage. Like,
mhm,
oh, the rate is dropping, when they were all going down during COVID. I saw
mhm.
the rates dropping. I'm like, that's the overnight rate for the banks. That's not necessarily the 30-year rate. Well, I heard it was like 0.25. I'm like, no, nope, mortgages are not down to 0.25. But I mean, but there is somewhat of a trickle down effect to that. And when the
Mhm.
rates are all going down, they generally, even the long-term ones, are going to go down with it too. So it's hard to know exactly when to do it. I think you have to have a good mortgage professional that watches things and keeps a close eye on things. I have a constant watch list of people that, I mean, just tonight I got an email from somebody that's on my watch list, and he was like, I'm just checking in, just seeing how things are looking, and they need cash out for a specific purpose, and we're just
Mhm.
trying to decide if it's a good fit for them to do it a certain way. So you
Right.
just got to have somebody that you know and trust. You can always you can Google and watch it. I see a lot of stuff online that's pretty misleading.
Mhm.
I see a lot of stuff online that is a really great rate because that's what people know to ask about, but you're being
Mhm.
charged a lot of points, what's called points, or which is extra closing costs, in order to get that rate. So be very careful with that.
Mhm.
Um, I promise you, if you ever aren't sure and you end up talking to another mortgage person and you want me to take a look at it, I know just how to figure out if you're being charged extra points. And unfortunately, that's a pretty common practice.
Mhm.
I hate to paint a negative, brush over what we do in our industry, but a lot of people they know that people know to ask about interest rate. So that's what they'll
Right.
market, and then they charge points and you don't realize it's there. So
Right.
something to look at.
So, talking about closing costs, can you roughly talk about like what's a good number for closing
Yeah.
costs?
Okay. So I'll tell you what ours are. I always tell people to estimate between 2,500 to 3,000 on a refinance. They're going to be rolled in. So you're not going to necessarily have, extra,
Mhm.
you're not going to have to necessarily come up with money out of pocket. A lot of times appraisals need to be paid when they're ordered. So if you need to have an appraisal done, that often
Mhm.
needs to be paid. The appraisal costs are, depending on the kind of loan, 450 to 550, somewhere in that
Mhm.
range. There's lender fees that may be 1,000 to 14 to $1,500, depending on the lender. And then the rest of it's usually title and county fees. So that all credit report is in there. That's usually like $30 to $40.
Mhm.
There's maybe some other, like, for example, some of the companies that we do verifications of employment with, they'll charge us $70 to get a verification, things like that. So there's usually some small miscellaneous fees, but usually in the ballpark of $2,500 to $3,000 that's pretty fair. If you
Okay.
choose to pay, points aren't a bad thing. I'm not saying don't ever pay them. You just
Yeah.
need to know that they're there. I don't like when points are charged to people that are unsuspecting.
Right. And so you can buy down your rate,
Yes,
basically, is what
yep,
you're talking
that's
about, right?
exactly what that is. Yeah, you can pay extra in what we call points to
Mhm.
get a lower interest rate. That's exactly right.
So that sounds like a big math equation to
It is.
decide if what you're paying extra works over the time of the money
Yep.
you're gonna save. Sounds like a headache to me, so.
That's my life. Figuring that
One big equation.
out. Yep.
Awesome, awesome. Well, are there any other things we didn't touch base? We talked a lot about a lot of stuff in the last 30-ish minutes.
A hot topic right now is investment properties.
Oh, yes,
So I'll
yes,
touch on that real quick before we jump off. But
please.
a lot of people are asking about investment properties. The biggest challenge with those, I would say, right now is that there just aren't very many to buy. So there's just not a lot of them out there to purchase. But I mean, I do loans for people all the time that are purchasing investment properties. I have several of them on my desk right now. If you can find the right situation for that, it's a great thing to do. If you can get into that, it does require more down payment. So earlier we talked about not needing 20%. The very minimum down for an investment property is 15, and you really, getting into 20 or 25% is going to get your interest rate quite a bit better. The rates are a little bit higher on them. Everything in lending comes down to risk. The risk of, and lenders are going to shell out $200,000, $300,000, $400,000 for you to purchase a home. And they want to know, are you going to pay them back? Like, that's what it comes down to. And when it comes to an investment property, they want to lower the risk because life circumstances happen. You lose your job and you've got a home, primary residence and investment property. Which one are you going to pay first? You're going to keep the roof over your head. So you're going to pay your primary residence first, which makes the investment property higher risk. So it requires a bigger down payment. There's more rules with them, but it's manageable. I mean, if you're in position to buy something like that, you probably can meet all of the criteria and the guidelines anyway.
And this brought up another good question. What's the minimum you can do a mortgage for?
Dollars wise? Well, I have one on my desk right now for $58,000.
Okay.
It's $150,000 house, and they're putting down around, $90,000 or $100,000. So around 50,000. It's a little bit different. Different investors have different minimums, but I'd say 50,000 is pretty close. Maybe 40 technically is the number.
Okay.
It's been a while since I've gotten down to that. Most houses are a little more than that these days. So I haven't gotten that low, but if someone has a big enough down payment, I have one on my desk right now. It's 58.
Right. Yeah. I'm always interested in investment properties, but it always seems like it's near impossible for like the standard person to get one.
Yeah, it's a little tricky right now, but working with a really great agent that knows that side of things pretty well and has had some experience in hunting some down is really great to be able to do that, because you can get the mortgage. I can do the mortgage for them easily. It's finding them that's a little trickier to do.
Yeah, absolutely. Absolutely. Well, I can't believe I missed that one on my question sheet.
I know,
that
one was your idea.
Into that. Yeah, exactly. What else?
I forget
Any
what
last words of wisdom?
Yeah, I just think, don't be afraid to jump into it. If you're on the fence about it, don't wait. I had to have some tough conversations with some people in January that did their pre-approvals before Christmas and said, oh, I'll wait till after the holidays and then we're going to start looking more seriously. And then the market shifted with the rates. Now, does that mean they shouldn't buy a house? No, they're at a point in their life, they're ready to buy a house. So that doesn't mean you shouldn't buy one and just, okay, never mind, I'm not going to buy them because the rates have moved a little bit.
Right.
The rates have moved because we had a pandemic. I mean, that's the easy answer, is because we had this pandemic. But that doesn't mean that home ownership isn't an amazing investment and it isn't an amazing thing to do when it's the right time and when you're ready. So definitely don't wait. If you're not sure, it's worth asking the questions and just being like, can we just talk through this and see? So don't be afraid of the market. Don't be afraid of the unknown. Don't be afraid to ask questions, but make sure you're asking them to a good, reliable source and not just internet searches are great, but they're not. Sometimes I cringe at what I see on there in terms of numbers. Like when people market numbers, it makes me go, "Ooh, that's not really accurate. That's not really numbers." So just, have real conversations and ask those questions.
Right. Megan has a lot of information and she is passionate about educating you guys. So if you're interested, shoot her a message, and that's what I'm going to ask her right now, how you can get in touch with her. And we will put it in the comments also.
So you can see I have quite the name, Megan Von Dilligan. You can see it down there at the bottom. I always tell people Von Dilligan rhymes with Gilligan. So that's the easy way to remember. Von Dilligan rhymes with Gilligan. But so you can find me
like little slogan.
I know, right? I should get that on my shirt. Or I should get like a necklace or something. It can be my symbol. But so I'm on Facebook. I have a business page on Facebook that's Mortgage with Megan, and then I've got my personal page that's Megan Miller Von Dilligan. And then my phone number, you can call or text anytime, is 317-697-2450. And my email is Megan, MEGAN, at themortgageexchange.com. So that's where you can find me. My application is really if you're like, I'm ready, let's do this. And you want to jump in and you want to fill out the information online as an application, it'll come directly to me on my desktop. And that's www.mortgagewithmegan.com.
Okay.
Yeah.
Will you be able to put all that information in the comment box
Sure.
on this page? And then
yeah, absolutely.
Yeah. Well,
I
thank
can
you.
talk about this for hours. It's such a dorky thing to talk about for hours, but I can literally talk about mortgages and lending for hours. So please let me know if you have any questions, but I'm just glad to get to see you. So thank you for
Yes.
having me. You have such a
Thank
great thing
you.
going. I'm just so excited for you.
Thank you. Thank you. Thank you to everyone that watched. Be sure to tune in next month, March 29th. I told you last month I was very excited about March. March 29th, I'm going to have a published author and pastor on. That's going to be amazing. So be sure to tune in for that, and I will get more information out as I solidify all the plans for that. Thank you, Megan, for educating us a little bit tonight about mortgages and all the things that go with it, interest rates and refinancing and down payments. Ugh. If you're catching the replay, be sure to hashtag replay, and we will see you guys next month. Thank you so much.
Thank you.
Bye.